Hey everyone, my name's Andy. I'm with Finding Value Finance. I'll be your host today. We've got Nick with us. AllThingsVentured is kind of how he goes off Twitter. He follows a bunch of different things. He's an investor and supports himself through investing. So thanks, Nick, for coming on. Really appreciate it. This is your third time on the channel, I believe.
So yeah,
So thanks.
yep,
Can you
good to
give
be
a
back.
quick overview, kind of your background, what got you into investing real quick before I start hitting you with a bunch of questions, just so everybody understands?
Sure, I've been I kind of when I was a kid, I dabbled a little bit in investing. I was that kid that asked like, "Hey mom, why is my money sitting in a bank account? What are stocks? What is this all about?" And she was kind enough to get me started and help me buy a mutual fund when I was probably 7 or 8 years old. And then when I turned out, went to college, got my first brokerage account, and which was in the middle of the bubble before the great financial crisis, where everything was going up and to the right, and kind of cut my teeth there, and did some day trading through college. What was that? So 2007. I mean, we're talking 15 plus years ago now, and have been kind of trading ever since. Worked a 9 to 5 for 10 years, running a import business, mostly glass containers coming in from China. And so learned a lot about trade, global trade, a lot about shipping, a lot about supply chain logistics through that process. And I think partly because of that, and partly because I just fell into it, shipping has kind of been my bread and butter niche that I trade and invest in markets. So, and it's been a really nice launching point because from shipping, you need to understand all the things that get traded, and that's commodities, that's finished goods coming over in container ships. And so it's been a really fun circle of competence to like grow out from and expand my knowledge base. So those are the kind of things that if I'm trying to talk and pretend to be an expert in anything, that those are my areas of expertise. And I dabble a little bit in macro.
So macro wise, what are you seeing on the macro front right now? What are some sectors that look good, bad, or just macro in general? What are you seeing in the big picture of things?
Yeah, so obviously, lately we're seeing a little bit of a reacceleration in inflation. We're seeing oil and commodities start to go up again, and I think it came as a surprise to a lot of people that really that markets have gone up as much as they have this year, and that we've not kind of entered into a recession yet. And so my personal outlook is I'm a little bit bearish on markets, but I'm kind of bullish on the long-term outlook on commodities and shipping. And so this past year has been a little bit of a balancing act between the two of, kind of waiting for this impending recession. Meanwhile, fundamentals do look pretty good on a lot of our underlying commodities and shipping.
And what do you use kind of as leading indicators for shipping? Like, what are some things that you follow? What are some things that you look at and say, wow, this is looking good, this is looking bad? What are some of those signals that you follow?
Yeah, so I'm constantly looking at trade flows and supply and demand, mostly on, okay, where are the products, especially for something like oil, right? You're looking at, okay, what's going on with supply and what's going on with demand and what's going on with trade routes and the balance of ton miles that are getting shipped. So for tankers, you're looking at what's Saudi Arabia doing, what's OPEC doing, what's happening with the war in Russia, how is that rerouting trade flows, and then with dry bulk, you're spending a lot of time looking at grains, you're looking at iron ore, you're looking at coal, and what's going on in that universe. So obviously, I spend a lot of time looking at China, what's going on with China, which has been a huge theme this year. There's been a huge slowdown in China with the whole zero COVID thing. And then coming into this year, we expected this, well, many people expected this huge reacceleration, which I think we can all agree has mostly fallen flat on its face. And now we're kind of in a phase of peak pessimism with China. And there's just like a lot of calls for China just falling apart. So I'm trying to get underneath the headlines and the sentiment and look at, okay, what's really going on in China? What is likely to happen with trade flows for commodities into and out of China? So it's if you're playing in shipping, you're spending a lot of time looking at what's going on with China.
And can you describe maybe what's going on in China? Is it good, bad, or anything that you're
Yeah.
seeing there?
So a lot of the pessimism that's out there is completely warranted. The Chinese property market has really finally hit the wall, and people have been calling for this for a decade now. China's got this big property bubble, whatever. This can't last, and it lasted for a decade, and they kept reinflating the bubble. What's happening now is it seems like China has definitely put their foot on the brake and is going to let this bubble in the property market deflate a little bit and let some of this inventory get reabsorbed. Now, we're starting to see in recent months, we're starting to see some indications that China might do more easing and more stimulus to try and stimulate their economy. The biggest one that jumped out at me was there was a huge tax break that was given out recently to all Chinese citizens that have dependents. So people are getting a tax break now if they have children, and they're getting a tax break now if they have elderly parents that they're caring for. So we're starting to see China take some steps to re-stimulate its economy. As far as that relates to properties, time will tell, right? I think right now Chinese people are very cautious. Youth unemployment is high, and the Chinese government wants people to go out and spend, but despite that, people just aren't spending. People aren't buying new homes. People aren't absorbing the excess housing inventory out there. And so, I'm really looking at some of the leading indicators on what's going on with steel production, what's going on with housing starts, this kind of stuff to watch when we've got an inflection point, or maybe, when the risk reward is good, that we've kind of hit a bottom. And to me, China showing a willingness to do some direct stimulus in the form of tax breaks is kind of an indication to me that we might be near a turning point on, the bottom in peak pessimism in China.
Do you watch iron ore, the price of iron ore directly?
I do. Yeah, and for dry bulk shipping, iron ore is king. It's it's over half of volume that gets shipped for dry bulk, and over half of that volume goes to China. So you have to watch iron ore very closely. And despite all of this pessimism, and I think that this will be kind of a theme through our talk, today, is despite all of the pessimism, despite the reality of really horrible housing starts and a really horrible housing market in China, the price of iron ore has stayed relatively elevated. In August, China just shipped the most iron ore, or imported the most iron ore that they have in a year. And despite all of this pessimism, dry bulk rates are still profitable. And so, when you have that confluence of factors and the macro just looks so bad, yet rates are still profitable. China just imported the most iron ore it has in over a year. The iron ore price is turning back up. Those are the kind of leading indicators that make your ears perk up and go like, okay, maybe we are hitting this inflection point. Maybe the risk reward now is good to buy dry bulk shipping.
Yeah, so we've got iron ore coming on up. I know you've been looking a lot at the dry bulk sector. I think you put together a presentation on some of this stuff, maybe more directly to show people maybe what you're tracking, what you're seeing in the markets. Maybe they can get a glimpse of that to see how things are going.
Yeah, so I got a few talking points that I'll share here.
Mm-hmm.
Let's go. All right, share my screen.
There we go.
All right. So Kind of from a high level, I just want to look back at, dry bulk is a hugely cyclical business. It goes in these huge boom bust cycles, and I kind of want to just take a high level where we are in the cycle. So this chart going back to, the early 90s, we see that, dry bulk was in this bear market, and then we had this huge upswing when China joined the WTO in 2002, where Chinese demand for commodities coming over in ships was just more than the current fleet could keep up with. And so there was, a 10-year period there where the world was building ships as fast as they could, and they just couldn't keep up. And so dry bulk rates went to astronomical levels. And then once those ships started to finally deliver, 2011, 2012, 2013, dry bulk rates crashed. They went into this long 10-year period of a bear market, and we started to see a new bull market emerge late 2019, and certainly in the COVID period. We saw that rates spike up to very high levels, and since the peak in late 2021, we've now kind of come back down, which I've kind of overlaid here the last cycle on this current cycle, and you can see the same kind of thing happened where we had an initial spike going into 2005, rates came back down, and then we made a final sprint into the astronomical rates that we saw in the 2007, 2008 period before great financial crisis and things crashed. So do I think that we're going back to those levels of rates? I'm not going to make that call. But do I think that some of the factors that we saw in the last cycle are going to be present as far as supply and demand goes this cycle? Maybe. Let's find out. So what caused a spike in 2021? We had some temporary factors that are no longer with us. And so that's why rates have come back down. One of the big things was COVID testing and quarantine inefficiencies for crew on ships. I was reading accounts that many ships that were trading to China, from China to Australia, were having to take 4-day detours to have COVID testing done in between. That's no longer happening, obviously. And so with those ships now back on efficient routes, that's a lot more supply that's been reintroduced. The other big thing that was happening in 2021 is China had a ban on Australian coal. And that kind of twofold caused kind of a tailwind for rates. One was you had a bunch of ships that were full of Australian coal sitting off the coast of China that had been shipped before the coal ban went into effect, that were sitting there waiting to offload and sitting there for very long periods, that were tying up shipping capacity. The other thing that was happening with the Australian coal ban is since the largest exporter of coal couldn't ship to one of the largest importers of coal, trade routes got rejigged. And generally, when there's something in the market like this that you can't have the most efficient trade routes, it causes supply inefficiency, and shipping routes generally get longer. And that's definitely happened in this case. So since then, China has relaxed that ban, and now China is also shipping in coal from Australia once again. So the third big factor that caused the rate spike in 2021 was container shipping rates were skyrocketing. Now, on the surface, you're like, okay, how does that relate? But the reality is that there are quite a few dry bulk items that get bagged and shipped on containers. And when container shipping rates went to $20,000 a container, a lot of those items that get containerized, like bags of rice, it's crazy, but I know that out of the Port of Oakland, they're shipping a bunch of logs in container, raw logs. They're shoving them into containers and they're sending them on the backhaul to China. A lot of that went away during this container rate super spike, and all of those things that could travel dry bulk went back onto dry bulk during that time period, which was a huge tailwind for rates. So now that container shipping rates are back down to, kind of long-term normal rates, you're seeing a lot of those dry bulk potential cargoes go back into container shipping, which has come back out of dry bulk. So in addition to those temporary factors that are now gone, there were some secular factors that caused the spike in 2021 that are still with us or at play. One is rising oil prices. When oil prices go up, ships tend to slow down because a large part of the operating cost of a ship and the economic decision on how fast to run the ship is the price of oil. So as just like the fuel in your car, the faster you go, the worse fuel economy you get per mile. So as oil prices go up, ships slow down. That means less supply. That means the rate paid to hire the ship goes up. And so I got a slide for that I'll show you next to show that correlation. Secondly, in 2020, there was a new regulation that required ships to have scrubbers installed, and caused a lot of ships to have to buy more expensive low sulfur fuel if they don't have a scrubber installed. So this combined with rising oil prices caused ships to generally slow down. And then in the past few years, we've had a very low order book and very few new ship deliveries. And that's something that's also ongoing right now. So this chart just is an illustration that generally dry bulk rates have a meaningful correlation to oil prices. And you'll see that, as oil prices were rising from, 2020 to the peak in June of 22, you kind of had a rising trend in dry bulk rates as well. From that peak in June of 2022, you also saw a second peak in dry bulk, and you've kind of had that same shape since then of dry bulk rates declining, finding a bottom, and starting to turn back up. So it's not a perfect one-to-one correlation, but this is a factor in both dry bulk rates and shipping in general, because it determines how fast ships go. So I think we talked a little bit about what caused shipping rates to fall, and we had talked a little bit about in our macro discussion this whole change in the China market, which is we've seen all the headlines with Evergrande and the other Chinese real estate developers. They're just not building like they used to. The bubble has definitely popped. Housing starts are way down, which is what you're seeing in this chart, which has been a huge headwind to dry bulk shipping and the dry bulk market. Now, despite the pessimism, dry bulk rates never really got down to significant loss-making levels. They've remained profitable despite all of this pessimism with China, and are now starting to turn back up. So let's kind of dig into why rates are starting to pick up. So I think we talked a little bit and Andy, interrupt me anytime if you got any questions, of course.
Keep going. You're good.
We had talked in our macro discussion that iron ore import volumes are starting to pick back up, and iron ore is well over half of dry bulk shipping, and well over half of that goes to China. So surprisingly, I think to many people's surprise, when you look at import data, August came in as the highest import month for iron ore into China in more than a year. And this is despite all the narrative about, property markets imploding, China's imploding. Well, iron ore is suggesting otherwise. Now, despite the highest month of imports in over a year, iron ore inventories are at their lowest, near the lows that they've been in the last decade. And so when thinking about, how to position yourself into dry bulk, this is going to be a tailwind going forward, because if inventories normalize to a higher level, that means inventory or imports have to pick up. And we're coming off of a month where it's the highest it's been in a year. And despite the highest it's been in a year, inventory still fell in China. Okay. Steel inventories, same story. They're at seasonal lows. There's this seasonal pattern that happens every year where steel inventories build over the Chinese New Year, which is that giant spike you see every year because everybody goes home to visit their family at the beginning of the year, but steel mills don't just turn off. They have to big furnace. Once you've melted that steel, you got to keep that thing on. You got to keep cranking. So steel inventories grow in the spring every year, get depleted, and right now are near all-time seasonal lows. So once again, if things normalize, this can only really go up. Okay. When we look at steel consumption and production in China, there's been a encouraging trend over the past few weeks where we see the 2023 gap to prior year's steel consumption is starting to close. Okay. It's been a pretty big gap all year relative to prior years. And when we look at rebar consumption and when we look at hot rolled coil consumption, we're starting to see that kind of close its gap between this year and prior years. Now, despite consumption picking back up in China, production is still looking pretty bad. Okay, which I think is what's reflected in those low steel inventory numbers. Consumption's going back up, but production hasn't followed yet. So now we're looking at yet another potential tailwind because in order to not continue to deplete steel inventories, production is going to have to eventually pick back up. And it's going to have to pick back up into record low or near decade low iron ore inventories coming off of a month of where we already are at more than 1 year high iron ore imports. Now, there's a little bit of cognitive dissonance if you're not thinking through all the variables here on, okay, how is it possible that we're importing such high levels of iron ore into China with steel production so far off? And I think the answer is that Chinese domestic iron ore production has gone down. Chinese domestic iron ore, it's really low quality. It takes a ton of energy to upgrade into usable product. And so with energy prices where they are, with the shortage where it is, and plenty of high quality seaborne iron ore available, we're starting to see China import the high quality seaborne ores instead of using their own ores. So from what I'm looking at as far as steel, the steel market, steel production, it looks like something's going on. Consumption's starting to pick up. Imports are starting to pick up. Maybe the people that are trading these products in China know something we don't know about the housing market in China. But either way that I look at it, this is a good starting point from a risk reward basis where, my guess is that we start to pick up on steel production and iron ore imports further from here. Taking a step back from, okay, what's going on right now to the big picture. The big bull argument for the dry bulk shipping in general is that it's really a supply story, meaning just like in a lot of the other cyclical businesses, CapEx has been really, really low over the last decade or so. Same has happened in shipping and especially in dry bulk. So right now, the order book for new ships as a percent of the existing fleet is still near its all-time lows at around 7%. And so to put the 7% in context, these ships have a usable lifespan of 20 to maybe 25, maybe 27 years. So just, thinking quick numbers, you've got to replace around 3 to 5% of the fleet every year to keep up with just obsolescence. And we're looking at an order book right now that's only 7%. And the next available slots at shipyards right now is out to well into 2026. So over the next 3 years, you got 7% delivering when obsolescence is 2+% per year. So what we're looking at from this standpoint is that the fleet is unlikely to continue to grow in coming years at any meaningful rate unless rates are high enough to keep the oldest, inefficient ships out trading. Okay, so regardless of what we think is going to happen with China, we know that supply is not going to be the problem because we're not getting any new supply. The supply that's coming online as far as new ships is barely enough to keep up with your standard obsolescence. The only way that supply ends up growing is if we get high enough rates to keep all these old ships out trading. So I think that's the last slide that I had for us. Keep talking through.
You trying to figure out how to stop share?
Yeah, I see it. There we go.
So that's the setup, right? We've got the setup. We've got looks to be increasing demand. We've got supply that isn't really going to respond. Looking at last bull market, were those the similar conditions during the last bull market? And did you follow the last bull market in shipping? Did you see what some of the potential returns could be in some of those dry bulk shippers? Can you give us a little bit of lay of the land of the last bull market, the setup last bull market, if it's similar to today, and then maybe some of the returns that occurred during that last bull market in some of the companies?
Sure. Yeah, it's a great question. So the last bull market, or as people like to call it in shipping, and commodities super cycle that we had in the early 2000s was very much a demand-driven market where, you had China coming online in the WTO and just importing crazy amounts of iron ore, coal, bauxite, grains, and that was an issue of all this demand and you couldn't build enough ships. Today, we're looking at a completely different supply-driven argument because I don't think that people expect that China is going to grow like gangbusters like it did in the early 2000s. And I don't think that China is going to grow like gangbusters. I think that we're more likely to see a very pedestrian, 1% to 2% growth in, iron ore imports and a very steady 3 to 4% growth in grain imports over the next decade. The big difference this time is that supply is so constrained. In the last cycle, when you had demand going gangbusters, the new ship order book got up to something crazy like, I think it was at 55% of the existing fleet. Today, it's at 7%. It's at 7%. So, back then, on a yearly basis, 2010, 2011, 2012, you were seeing every year 15% of the fleet get delivered, 15% growth in supply, until basically there was just so much new supply coming on that rates got crushed. Now we're looking at the exact opposite, which is, okay, demand might not be really crazy for growth, but we are bordering on negative fleet growth here. And because we had this kind of boom in container shipping, and we've had a boom in LNG shipping, and we've had a boom in LPG shipping, and there's a boom going on in car carrier shipping because China's starting to export a bunch of cars to Europe and North America. All of the space to build new ships in the shipyards is all booked up with container ships, LNG carriers, LPG carriers, car carriers. And there's really no space left to put in tankers and dry bulk ships until 2026, 2027. With the way that things are going for LNG, LPG, car carriers, we're likely to still see heavy ordering well into the end of the decade for those segments that is still going to take up shipyard capacity. Now, In 2000 and 2005, 2006, when we started to see this like shipbuilding boom, hundreds of new shipyards opened in China to build ships. But to put that into context, back in 2006, 2007, these were crude, unsophisticated ships. You know, they were big steel tubs with, you know, very simple diesel engines that were burning high sulfur fuel oil. You know, any like hack job that saw his cousin do it in China could open a shipyard and build ships. The ships were a lot smaller 20 years ago. And today it's an entirely different thing. We have new green regulations that require these ships to be the highest specification, most fuel efficient. All of the excess or incremental capacity that's coming online for shipping is not competitive unless it's the biggest of the big ships. And so, you know, it's not easy for a new shipyard to just go and pour a new dry dock in China that's going to build the biggest ships. This is a multi-billion-dollar endeavor to build a new shipyard, to build new shipyard capacity, and we're just not seeing it come online. We're seeing a small amount of shipyard capacity get reactivated. That is shipyard capacity that went bankrupt in the last bust, but really the excess capacity that's getting turned back on is relatively small to the level of new ships that are going to need to be ordered by 2030. And I've not seen a believable explanation for how we're going to make enough new ships to replace the ones that are becoming obsolescent between now and say 2035. I can throw out some theories on how the world might accomplish this goal, but I think it's going to take massive like state intervention of like China coming on and saying, okay, shit, we don't have enough shipping capacity or shipbuilding capacity. We need to like build some new shipyards, but we've not seen that yet. So we're at least, figure if China came in and said, okay, we've got this looming problem. We need to build more shipyard capacity. And they said that today, maybe we have more shipyard capacity that starts building ships in 2 years. So now we're out to 2025. So they lay a keel in 2025 for a ship that'll be available in 2027. So there's no quick solution to this. There's not enough ship building capacity out there. There's not a large enough order book. You can't order a new ship, especially a new large ship, like a new Cape-size ship, for delivery before 2026 right now. And so we have a largely fixed order book, 7%, which is about obsolescence. Despite all this Chinese pessimism, rates are still profitable. Rates are turning back up. Market seems to know something that headlines don't know. Risk reward starting to look pretty decent here.
And looking at previous cycles and the potential maybe squeeze that we could see in dry bulk shipping, what do you think the potential returns could be? Looking at last market and maybe this market, do you think there's a lot of, we'll call it juice, that's worth the squeeze here? You think there's a lot of upside, and what's your opinions around that?
Yeah, so I think that especially in the next couple of years, I'm not expecting anything crazy spectacular. My expectations are that rates remain at healthy, profitable levels, but we're not seeing the crazy kind of rates that we saw even in late 2021 or in the last super cycle. But I suspect that after we get over whatever kind of recession, soft landing, whatever thing we have, and China stimulates out the other side, and China kind of like consolidates its property bubble and starts building again, we could see some super cycle type rates come back in the back half of the decade. But where a lot of these dry bulk stocks are trading right now, they're trading at 3-4 times expected next 12-month earnings. and they're paying huge dividends now, and everybody's buying back stock. Everybody repaired their balance sheet during the last spike. And now you're sitting here 3-4 times forward earnings. People are buying back stocks, paying you a dividend. You're getting paid to wait for what I think could be some pretty spectacular stuff towards the end of the decade, as that huge amount of ships that delivered during the last super cycle starts to reach obsolescence. And because we have new regulations that came in requiring ships to meet certain environmental standards, I suspect that the ships that were built in the big shipbuilding boom from, say, 2008 to 2013, that were not eco ships, that get 30% worse fuel mileage than your latest and greatest ships today. I suspect that those ships are not going to make it to your 25-year lifespan. I think that we're more likely to see those ships get taken out just because they're not economic, or they're not allowed anymore, something closer to 20 years.
And I know we're focusing on the supply stuff in terms of shipping and all that stuff. Is there some sort of external factor that's an input to shipping that could completely change this? So I'm just going to give an example. What if oil is 150 or something like that? How does that impact shipping? If we get an oil price that's like $150 or something like that, is it going to, what's it going to do to the shipping, dry bulk shipping?
Yeah. So if I see $150 oil, I'm going to have two thoughts. One is, oh shit, that's going to crash the economy. Watch out. Right. Which I think from a macro standpoint, everybody should be worried about. But higher oil prices this is often like misunderstood and thought of wrong, but it is 100% bullish for shipping. At $150 oil, ships are going to slow down massively. Day rates are going to go up. So until that point, where high oil prices crash the economy, higher oil prices are bullish for shipping because it constrains ship supply.
And where do you think that you get a cost value curve, you come up and then it kind of like levels out. Where do you think that curve is where ships can go fast up to a certain point where they're like, you know what, we need to slow this thing way down? Is it like $80, $90, $100, $110, or is it kind of a slow, smooth curve where things start to slow down as prices go up? What's your opinions around that?
Yeah, so when you actually look at the fuel efficiency curve, it's your typical exponential curve. So as you go out the curve, your fuel requirement per mile or kilometer traveled is going up exponentially as you go out the curve. So it's typically a very steady thing, rather than like, okay, there's a hard point where at $120 a barrel, suddenly things crash, right? And it's something that you don't see talked about a lot because it's hard to measure. There's a lot of other factors that are swirling around at all times with supply and demand and day rates, and this is constantly in balance. Like if day rates are very high to charter the ship, then ships will typically speed up to make more trips and carry more cargo, right? But then you're spending more fuel, and so those two things are constantly in balance, and so it's often really hard to measure and really put a quantitative thing to it. But I can just tell you from looking at it from my experience, higher oil prices definitely bullish for shipping.
So like if I were to just, I mean, I know this isn't, you're not going to be exact with this, but like last bull market in shipping, we saw those rates just massively go up alongside oil did in 07, 08.
Right.
Do you think that was mainly driven by supply demand tightness or driven by the oil input portion of it? I mean, just curious.
Yeah, no, definitely the lion's share of that was just supply demand tightness. You had China with just an unsatiable appetite for everything, and there were not enough ships out there, period. And at that time, those ships were going as fast as they were safe to travel and could technically travel. I think that, in 2008, any kind of cargo ship was running basically as fast as that diesel engine could go. Didn't matter what the oil price was. And I think that we could, at the end of this decade, for a lot of categories, go back to something akin to that. Other than the fact that I don't know if the environmental groups are going to allow it this time, and new regulations might not allow it this time. So in the last super cycle, those ships were burning as much fuel as they could because the fuel was way cheaper than day rates. This time, that might not even be an option. So if we really do get a squeeze and a supply-demand imbalance, I mean, there's a scenario out there where rates could go, even higher because you can't just dump oil at it and make the ships go faster.
Yeah, that'd be kind of interesting. And the order book, if you looked at the order book, it looked like there was a huge spike in the middle of 2020 or 2000s to late 2000s, 04 all the way to like 2010. It spiked up like that. That means that if these ships only last 20 years, that we are going to have a gigantic amount come out of the fleet, all coming into late 2020s. Is that a fair statement?
That's exactly right. So, and then this was my commentary. I don't think the world has figured out how they're going to replace these ships yet. Current shipyard capacity is something like 50 million, gross tons a year. And right now that amounts to, I think, like 3%, 4% of the world's fleet every year is what we technically can build per year. And so total shipbuilding capacity has reached the point where it's equal to total obsolescence. We don't have enough shipbuilding capacity to continue to grow the world's fleet, even though secularly trade continues to grow every year. Ups, downs, whatever, trade continues to grow. We will need a larger fleet, but we haven't built the shipyard capacity yet to accommodate that, let alone replace this very lopsided, fleet where we have all of these ships that were built from 2006 to 2013.
So they're going to get flooded. They're all going to come off, and then there's going to be not enough capacity to build them at all. Is that
Exactly.
a fair statement?
Exactly. And the existing shipyards out there, they still have not put in very many profitable years. All of their balance sheets are just darn near broken. So they're going to have to book a few profitable years before they even have a balance sheet that's strong enough to invest in new capacity. So this is why these cycles go in these kind of like 10, 15-year cycles, because even though the writing is on the walls, there are just realities about the cycle that prevent a very quick response. And I think one of the telling things is we had that huge spike in rates in the early 2000s, and we had a huge immediate response in the ship order book. But look at this huge spike in rates that we had in 2021 and into 2022, and look at the order book. It has continued to fall as a percent of the existing fleet. So that tells you that there's other factors out there that are preventing, these new cash-rich ship owners from going out and buying new ships. It's just not happening right now.
What other questions should I be asking about dry bulk? Because again, I'm not I don't know everything about dry bulk. Is there something that you'd like to share, or something that you'd like to kind of add that I'm not asking about dry bulk?
Sure. Yeah. I mean, I would definitely be asking, okay, what are the risks here to, a bull thesis in dry bulk? Like what are the potential black swans out there? I think that the thing that we need to continue to monitor is the China situation and the global economy and recession. Trade, and I think that this is why these stocks do trade so cheap, even though they're hoovering back shares and paying very nice dividends, is because people are worried about a recession. Recession will be a problem for all things trade. And, if China really does implode, that's gonna implode all things trade as well. So, if we see a Taiwan invasion and we see sanctions come out of the US, I wouldn't necessarily conclude that that's going to be bearish, but it could be a huge problem. You look at what happened with sanctions with Russia, that was wildly bullish for tankers. And, that was something that was obvious to me as soon as the war started, that we were going to have, that those sanctions are going to be wildly bullish. I can't necessarily say the same thing about some kind of conflict with China and any sanctions that come out of that. It's just too much volume. It's too uncertain. Something to know before, you get involved in this space for sure.
You said that they've got a lot of kind of, I'll call it crappier iron ore over in China. And you said they were going to import from other places, higher quality iron. Where's that coming from? Do you know by any chance? Like the biggest iron ore producers?
Yeah, so really, really easy. The vast majority of the world's traded iron ore comes from Brazil and Australia. Okay. And most of it comes from Australia, but lately all of the incremental production, or most of the incremental production in recent years, has been coming from Brazil, which is about as far from China as you can get. So each additional unit of iron ore that we add is not the same as, the units of iron ore that we're already shipping. You need a lot more shipping capacity to add an incremental traded unit of iron ore from Brazil than you do from Australia or, somewhere closer. And on that front, you always got to be looking at where is additional supply going to come from in the coming years. Now, Brazil has plans in the works to increase supply by something like 20% over the next 5 years. Okay. Which would alone require more Capesize dry bulk ships than are currently on order. Now, the big company that ships iron ore from Brazil is a company called Vale, and they have a history of not meeting their production target. So, you have to take everything that they say with a grain of salt. But at the same time, we do see things that they're doing and investments that they're making that suggest that they might actually bring on 20% more capacity over the next 5 years. They're building a huge new port complex in the north of Brazil that's going to be able to ship more iron ore than where they ship most of the iron ore from right now. So to me, there's a lot of skeptics out there that are like, okay, yeah, they say that they're going to ship all this, they're going to increase production by all this amount. And, they never seem to hit their targets. But I see it as a real possibility because they're dumping all this money into this huge new port. You don't do that unless you are going to actually bring in a lot more production capacity. So that's one of the big main developments that you got to watch. And then the second one is that the largest untapped reserve of iron ore, high quality direct shipping iron ore in the world, is in West Africa. It's in Guinea. It's called Simandou. And this has been a project that's been in the works for a number of years. There's been a lot of skeptics on this one, on whether this project will ever get done. And, but a few years ago, the Western companies that were running this project sold it to a Chinese outfit. So it's majority Chinese owned now. And I have a lot more confidence that the Chinese will bring it online on schedule in 2025, like they say they will, now that it's under Chinese control. The Chinese are much better at operating in Africa, and they have a vested interest in getting a new iron ore supply, because right now they're basically handcuffed. They have two sources of supply. They have Australia, and we've seen the tensions with China and Australia there, and they got Brazil. And so now we have a Chinese-owned company bringing in on the largest new high-quality iron ore supply in the world out of West Africa. supposed to happen in 2025. My guess, it comes online sometime in 2026. And like I've said, both on the Brazil thing and on the West African supply, there are not enough ships on order right now to carry that incremental volume.
So what's the strategy here then? What should the normal investor be doing?
So my strategy right now for dry bulk is just, it's a buy and hold. I put in I bought a ton of dry bulk exposure back in late 2019. No, I'm sorry, late 2020. And honestly, I've not really reduced it much. I'm holding it for the cycle. I'm holding tankers for the cycle. I do a little trading around the edges, but unless you're an expert in the sector, my advice for the sector would be set it and forget it, buy and hold. The fundamentals are only going to get better as we go into the back half of the decade. It's an incredibly volatile business. We looked at that chart, rates will 10x and then they'll crash and whatever else. And there's all this interim volatility. But frankly, the best thesis is coming at the end of the decade. I like where we're at right now. Things are turning up, rates are turning up. Everything looks good of why now, but ultimately, shipping is not for the faint of heart. It's not for the novice, really. So, I would be comfortable saying the buy and hold is the way to go.
And just curious, I know that you follow iron ore quite a bit. Do you like the iron ore producers or steel producers or anything like that?
I do. Yeah. Iron ore used to be kind of a bad business. There was a ton of overcapacity when, especially when Vale in Brazil started to ramp production. And there was a lot of skepticism on whether, the iron ore market would ever balance, or if it would be kind of like the oil market, where as soon as prices go above profitable, there's all this new supply comes on and prices crash again. And the last 5 or 6 years, we have started to realize that is no longer the case. This company, I like to liken this company in Brazil, Vale, as the Saudi Arabia of iron ore. And they have done an incredible job at managing supply. And when China slows down, they pull back on production and they keep the price up. And we've seen incredibly stable high prices of iron ore, yet these stocks are still priced like there's an imminent iron ore crash coming. And I'm starting to be of the opinion that, even if China worsens, Vale will adjust production accordingly to keep the price up. That's what we've seen for years now. And that stock is cheap. That stock is like, I think it's trading at something like 5 times forward earnings, and a lot lower on trailing earnings. So that's I don't currently own that stock, but that's something that's always on my watch list. And something that I've actually been thinking about buying recently. It's kind of at a compelling price level right now.
Yeah, I own a big chunk of it, just to let you guys know.
Yeah.
Getting paid to sit with the big dividend.
I think you're going to do well with that one. Yeah, that's you heard it here first. Is the Saudi Arabia of iron ore.
Good. Yeah. Is there anything else that you'd like to share? Anything that you've got on your mind about any sector or anything?
Yeah, the other sector, I know we're talking a lot about dry bulk today, but people should take a look at tankers too. So I'm pretty long tankers. I think that a lot of what we talked about in dry bulk applies to tankers as well. So pretty excited about that sector. That's another buy and hold for the decade for me.
Big dividends over there too.
Huge dividends. Wow. And we're seeing this, I'm seeing this effect starting to happen, which is balance sheets are getting repaired across shipping. And a lot of these ship owners, whether, their core company is dry bulk or tankers or whatever else, once their balance sheet is repaired, these guys start looking in other sectors, and the capital starts flowing from the sector that's booming to the other sectors. But now they're all cash rich. They're all buying back their shares. And so that has this kind of effect together where it starts to push up all the share prices and all the valuations across the sectors. And you got the container shipping companies, you got Costa Mare and now Danaus, that used to just own container ships, and they're starting to buy dry bulk ships. And these are pros. These guys, that's another thing that you want to be watching with the cycle. These guys live and breathe shipping. And what are they doing with their excess cash? They're not buying back their own shares. They're not buying more container ships. They're buying dry bulk ships right now. So that tells you that that's where those guys are seeing value in shipping. And so, yeah, there's just a lot of positive tailwinds across the shipping sector right now, which is what you like to see. Even if you're bullish on, one particular sector, it's good to see the whole sector be cash rich, because they're all going to start bidding up asset prices. Dividend, we're hoping at some point we get a buyback, but regardless, if we get the cycle that I'm expecting, that thing's a multi-bagger.
Well, that's all I've got. If anybody wants to follow you or reach out to you, how do they do that?
So I'm on Twitter, AllVentured. Yeah, feel free to hit me up, send me a direct message. I'll try and, share what I know. Lately I haven't been posting as much on shipping, but kind of waiting for the shoe to drop with the markets. And I'm glad you reached out, Andy, because I think now is kind of a good time for dry bulk, and I'm starting to get really excited about tankers again. And so hoping to post more about shipping.
All right. Well, thanks for coming on. I really appreciate it. Thank you, Nick.
All right. Thanks, Andy.